Hey everyone, and welcome to The Explainer. Today, we're strapping in to look at a truly fascinating, honestly, kind of dramatic corporate story straight from the aviation industry. We're going to examine Aeromexico's Q2 2026 earnings report. Now, this is a story of an airline operating at the absolute peak of its commercial powers, achieving incredible sales, yet simultaneously flying directly into some of the most serious economic headwinds imaginable. It's a masterclass in how companies survive external crises, and understanding it might just explain why your next vacation ticket costs exactly what it does. So let's just dive right into it, because here is the ultimate flight path puzzle we're going to solve today. How in the world does a company achieve a massive milestone like $1.5 billion in a single quarter, yet when the dust settles, they actually find themselves in the red? It seems totally contradictory, right? But as we break down the data in this explainer, you'll see exactly how global forces can challenge even the absolute best business strategies. First up, we've got to acknowledge the massive top-line triumph here. Aeromexico brought in a staggering $1.5 billion in total revenue for the second quarter. That is a 12.6% jump year over year. And to put into perspective just how strong their commercial engine was running, they actually achieved their two highest weekly sales in the entire history of the company during this exact same period. I mean, demand wasn't just resilient, it was completely surging. CEO Andres Cansa really summed up the quarter perfectly. He noted their solid results, but he immediately pointed to peak fuel price pressure along with demand shifts tied to the World Cup. And this quote establishes the core tension of our whole story today. On one hand, you have incredibly solid execution and record sales. But on the other hand, you've got massive external macroeconomic pressures just bearing down on the airline's operations. Section 1. Record highs and turbulence. Okay, this right here captures the entire quarter in a single comparison. You've got a fantastic 12.6% increase in revenue going head-to-head with a massive 79.9% spike in total fuel expense. Essentially, the airline was selling tickets faster than ever, but their jets were drinking fuel at a premium that literally devoured those profits instantly. It's the classic business battle, right? Top-line growth versus bottom-line costs. And well, here is the hammer drop. Because of that massive disparity between the revenue growth and the fuel cost spikes, Aeromexico ended the quarter with a $57.7 million net loss. So that answers our initial puzzle. This is exactly why a record $1.5 billion in revenue simply didn't translate to profit. The fuel just cost way too much. Section 2. The massive fuel headwind. To really understand the severity of this geopolitical fuel crisis, just look at the massive leap in cost. Back in the second quarter of 2025, they were paying $2.34 per gallon of fuel. Fast forward to Q 2026, and that price skyrocketed to $4.20 per gallon. That is nearly double the cost. In total dollars, this single uncontrollable metric created a $219.3 million year-over-year expense jump. For an airline, there's just no way to completely hide from a commodity swing that massive. So, you might be wondering, how is the airline performing outside of that wild fuel market? Well, to figure that out, we use an industry standard metric called CSMX. This stands for Cost Per Available Seat Mile Excluding Fuel. Think of it as stripping away the volatile commodity market so we can reveal the baseline operational costs that the airline actually has control over. But here's the thing. Even when we completely take fuel out of the equation, Aeromexico's base costs still rose. Their CSMX actually went up 12.3% to 10.0 cents. Why? Well, they face three distinct non-fuel headwinds. First, the Mexican peso appreciated by 11.3%, which directly impacts their cost basis. Second, like a lot of companies right now, they faced inflation-related wage and salary adjustments. And third, because they expanded their fleet back in 2025, they had higher depreciation and ownership costs. So it wasn't just fuel. Even their standard operational costs were rising during this quarter. Section 3. The Premium Profit Engine. So, what was their main defense mechanism against this massive storm? Well, it was the front of the plane. 43% of their passenger revenue mix actually came from premium products. In a quarter where fuel was just eating away at margins, getting travelers to pay for premium upgrades, extra legroom, and ancillary services was absolutely vital. In fact, this premium revenue mix reached an all-time high, which really proves the power of their brand, even in a super tough macroeconomic environment. To truly grasp the impact of that premium push, we have to talk about TRAS, total revenue per available seat mile. Think of this as the ultimate efficiency score for how well an airline monetizes every single seat it flies. It combines base fares, those crucial premium upgrades, and extra fees all together. In Q2, Aeromexico's TRAS hit 16.0 cents, which is a 10.5% increase. This is a massive victory because by driving this revenue metric up so high, they were actually able to recover about 75% of those crazy incremental fuel costs we talked about earlier. And that high-yield revenue wasn't just coming from domestic flights, not at all. While local revenue did grow by a very healthy 10.2%, international revenue completely surged by 13.9% to hit $958 million. This really shows us that their strategy of expanding international operations and capturing that high-yield global traveler is paying off in a major, major way. Section 4. Fleet Growth and Liquidity. Now, despite all of those intense economic headwinds we just talked about, Aeromexico didn't pump the brakes on their growth. They are still physically expanding the airline's capabilities, ending the quarter with a massive operating fleet of 169 aircraft. And they aren't just hanging on to aging jets either. During Q2, they actively added new hardware to the fleet, taking delivery of 2 Boeing 737 MAX 8 aircraft and 1 Boeing 787-9. This keeps their average fleet age down to a very young 8.9 years. And why does this matter for our story? Well, this isn't just about having shiny new planes for the sake of it. It's a direct shield against those crazy fuel prices. Thanks to this modern fleet mix, their actual fuel burn rate per available seat mile decreased by 1.7%. Basically, they used less fuel to fly the exact same distance, which really helped blunt the impact of the price spike. In a quarter where soaring fuel costs were literally threatening to drain the tank, they still managed to hold on to a rock-solid $1.2 billion in total liquidity without taking on a single cent of new financial debt. This is an absolutely crucial takeaway. They maintained a massive cash cushion, which is equivalent to 21.8% of their revenues over the last 12 months, and they managed to do this solely through really strong operating cash generation. Section 5. Clear skies ahead. Remember that brutal $4.20 per gallon obstacle we talked about? Well, the biggest headwind of Q2 is expected to rapidly melt away. Aeromexico actually forecasts that fuel prices will drop significantly, down to $3.20 per gallon in Q3 and even lower to $3 per gallon by Q4. The pressure is finally coming off. Which brings us to an absolutely thrilling roadmap for the rest of 2026. For Q4, not only are fuel costs dropping, but the airline is preparing for aggressive capacity growth of 6.5 to 8%. When you combine more capacity, record premium revenue, and suddenly cheap fuel, you get massive margin expansion. They're actually guiding for an operating margin of up to 18.5% by the end of the year. So that leaves us with one final, pretty provocative thought. We watched them hit record revenues while fighting the absolute worst fuel market imaginable. Now, with fuel prices finally cooling off, a young, efficient fleet, $1.2 billion in cash, and a record premium revenue mix, is Aeromexico poised to absolutely dominate the skies in late 2026? The explosive potential for the upcoming quarters is literally impossible to ignore. Thank you so much for joining me for this explainer. Keep learning, and I'll catch you next time.